Okay, I guess let's get started. So let me first introduce myself. My name is Tanmay. I'm heading the operations at MProfit, and I have Radha Mehta with me. She's basically a CA and also managing the entire business module in MProfit. So today's webinar is basically focused for the tax season, I would say, and we are going to cover different tax rules, how you can do tax loss harvesting using MProfit. So we are going to go through every single asset class, stocks, mutual funds, REITs and InvITs, different types of mutual funds as well, bonds, and various other asset classes. We'll also talk about how different assets are taxed and how you can easily generate reports from MProfit and use it for filing purposes. So I think Radha, we can get started.
Yes.
Just want to add one more thing that we are going to open Q&A floor at the end of the session. So if you have any questions, I'll request you to hold on that. So once we cover the entire flow, all the topics basically, then we'll take the question and answers. Okay.
Thanks, Tanmay. Yeah, we can get started. So this session is specifically for the capital gains for financial year 25-26. And like Tanmay said, we'll go asset class by asset class. Tanmay, we can go to the next slide.
Yeah.
So before we get into detailed asset class taxation, one important thing we should discuss is about the mutual fund categorization, which is applicable for this year. There was a new section of section 50 AA, which the definition of debt mutual funds has changed, because of which the categorization has slightly tweaked with the addition of hybrid mutual funds clearly classified now. So the first category is equity, where if the fund is having greater than 65% equity exposure, then it will be classified as an equity mutual fund. If the exposure is greater than 65% in debt and money market instruments, it will be called as debt mutual fund, which is also called as specialized mutual fund. And if it is not falling between the two, if it is between 35 to 65%, then the category will be a hybrid mutual fund category. So three categorizations: equity, debt, and hybrid. Now moving on to separate asset class taxations. The first is the stocks and equity mutual funds. In this category, there has been no change for the last 1 or 2 years, where it's a simple classification. If the holding period is greater than 1 year, it will be classified as long term. If the holding period is less than 1 year, it will be classified as short term. For this financial year, the taxation rules are as such. If it is a short-term capital gain, then the tax rate is 20%. If it is a long-term capital gain, it is a 12.5% tax rate with an exemption limit provided of 1.25 lakhs. So for stocks and equity mutual funds meaning where the equity exposure is more than 65%. We'll just show you one example of that. So Tanmay will show you how you can generate the report in MProfit and how that report will be seen.
Yeah. So we have already added some of the data as you see in the portfolio, and many of you must be already aware that you can easily import the transaction details in MProfit through import of contract notes of a mutual fund. We have a CAS API functionality available where you can easily fetch the transaction details into MProfit. So once you add the data in your portfolio, you can go to individual portfolio like this, and on the top right hand side there is a report section available. I can click on the reports, go to capital gains, and I can generate capital gains in ITR format. So as you see, there is a stocks separate section available similarly for mutual fund equity. Just to show you this particular example, I can click on this stocks. By default, current financial year will be selected. But if required, you can also select specific period and you can simply click on generate report to generate the capital gain report. Now, this is example for basic equity data. So for Infosys, as you see, there was a purchase in 2017 and sold in this particular year, August 25. So it is considering it as a long-term capital gain. And as this asset was purchased before Jan 2018, so the grandfathering clause is applicable. That's the reason you also see FMV price on 31st Jan 2018, and accordingly the long-term capital gain will be calculated. All these reports are easily downloadable, so you can download it in Excel and PDF format as well. Same goes for mutual funds also. If you want to look at the mutual fund data, equity mutual fund reports, there is a MF equity button available, section available. I'll click on it and I can also generate a similar report. This is for equity mutual funds basically. Like this. So this is one of the equity mutual fund. Here also it was purchased before Jan 2018. So the grandfathering clause is applicable. And you can see that it's basically considering it as a long-term capital gain. So if there is a short-term, long-term, you will see everything in single report as well. Just you can look at the asset name column where there's a label called long-term capital gain. Similarly, if there is a short-term, that will also appear in the same report.
Yeah. Thanks, then.
Yeah.
We can move to the next category, which is the debt mutual funds. In case of debt mutual funds, there are two things that we need to take care of: purchased before 1st April and purchased after 1st April 2023. The debt mutual funds which are purchased before 1st of April 2023, in that case, there is a long-term benefit which is provided to these mutual funds, which is the holding period is less than 2 years. Then it will be classified as short-term. If the holding period is more than 2 years, it will be classified as long-term. For short-term holding period, the tax rate will be taxed at the individual slab rate, depending in whichever slab that individual is falling under. And if it's a long-term capital gain where holding period is more than 2 years, then the tax rate will be 12.5% with no indexation benefit provided. This is applicable only if the mutual fund is purchased before 1st of April. And this is specifically for debt mutual funds where the exposure is more than 65% in debt and money market instruments. If the debt mutual funds are purchased after 1st April 2023, which is the next slide, then there is no benefit of long-term holding provided to these for these mutual funds. Everything will be classified as short-term, irrespective of when you sell it, whether it is 1 year, 2 year, 3 years, will not matter. It will always be considered as short-term, and the tax rate will be as per the individual slab rate. So this is specifically for debt mutual funds where there are two distinctions: before 1st April, where long-term benefit is provided for 2 years, and if it is purchased after 1st April 2023, then there is no long-term benefit provided. Everything is short-term. Tanmay will just show you an example.
Yeah. So just to show this specific data in the report section, I have already added two different funds. One is HDFC Low Duration Fund, and second is the Kotak Bond Short Term Plan Growth Fund. Both are debt funds basically. You can see the transactions as well. Uh, so to generate the report, you can simply go to the report section again, select any of the capital gain reports, and now as we are generating debt report, you can open this MF Debt Hybrid report. Okay, by default, again, the period will be selected as current financial year, as we are in the current financial year. You can just generate the report. So I've covered both the criteria. So for HDFC low duration fund, which you see here, it was purchased before 1st April 23 and of course sold in October 25. So it is considered as a long term. Whereas if you see the Kotak bond short term fund, it was purchased after 1st April 2023. You can see the purchase date column, and it was sold in recently, basically in November 25. So it is still considered as a short term capital gain. This is the automatic bifurcation we are doing. You don't need to worry about all this. Just that once you add the accurate transaction details in MProfit through CAS API or through file import, all this uh, uh, criteria will be automatically considered and you will get the ready-made capital gain report.
Yes. Okay. Next, moving on to the next category, which is the hybrid mutual funds. Along with this, we are also talking about gold and silver mutual funds and international mutual funds. The reason why we are talking about all of this together is the same rule of taxation applies to all three categories: hybrid mutual funds, gold and silver, and international mutual funds. Here, the holding period benefit given is of 2 years. So if you have purchased the asset and sold within 2 years, then short-term capital gain will be applied at slab rate. If you have sold this asset post holding it for 2 years, then it will fall under long-term capital gain, and the tax rate will be 12.5% without any indexation benefit provided to you. Here it is important to know that for hybrid mutual funds, the definition was specified just last year. Before that, there was some ambiguity regards to hybrid mutual funds. And now it is very clear that for hybrid mutual funds, if it is between 35 to 65%, holdings, only then it will be classified as hybrid. If it is more than 65 in equity, it is pure equity. If it is more than 65 in debt and money market, it is purely debt. Other than that, everything will fall under hybrid. Gold and silver are specific commodity mutual funds, and international mutual funds are funds in which investment is done for scripts which are listed out of India. So here the taxation is simple, where it is for a 2-year holding period. Short term is at slab rate and long term is 12.5%. And we will show you one example for this category.
So I'll again go to MProfit. So I've already added one fund basically, which is a quant multi-asset allocation fund. It's a hybrid fund. Again, to generate the report, we have to simply use the same report because for bet and hybrid, it's the same report available. As I've already generated this report, I'll simply go to report logs and I'll generate the report from you. So the first fund you see, quant multi-asset allocation fund. There is no such criteria pre and post here. So if it is less than 2 years, it will be considered as a short-term capital gain. If you're holding it more than 2 years and then selling it, it will be considered as a long-term capital gain. In this particular example, if you see the very first fund, quant multi-asset allocation fund, the duration, holding duration is basically less than 2 years, and it is shown as short-term capital gain. Moving to the next point.
Yes, correct. Next, we move on to fund of funds. There are three categories of fund of funds again: debt-oriented fund of funds, equity-oriented fund of funds, and of course the other than debt and equity, which is hybrid, gold and silver, commodity, international, etc. For debt-oriented fund of funds, similar to how we had for debt mutual fund, there is a distinction between purchased before 1st April and purchased after 1st April 2023. Debt-oriented fund of funds, again, the definition here suggests that fund of funds who invest more than 65% in debt funds, then they will be classified as debt-oriented fund of funds. Here the taxation is again 2 years. The holding period is of 2 years. So if you have sold it before 2 years, then it will fall under short term and it will be added to your slab income tax slabs, and the taxation will be as per your slab rate. If you're holding it for more than 2 years and then selling it, then it will fall under long-term capital gain, and the tax rate will be 12.5% with no indexation benefit provided to you, similar to how we have seen for other funds as well. Next, debt-oriented fund of funds, but the ones which are purchased after 1st April 2023, again, these funds will fall under short term irrespective of the holding period, and they will be added to your income and will be taxed at your slab rate. So again, for debt oriented fund of funds, the definition is, just to reiterate, funds which invest more than 65% in debt funds will be classified as debt oriented fund of funds, and in such cases the distinction will be before and after purchase of 1st April 2023. We'll show you just one example for this.
Yeah, maybe Radha, we can cover the other ones as well, then we can just talk about one example. Yeah.
Sure. The next one is the equity-oriented fund of funds. In this case, the funds, the FOFs, which invest 90% of their units in another equity fund listed on recognized stock exchange, which we know is any ETF, right? So if the fund is investing more than 90% in any equity-oriented ETF, in that case, they will be called as equity-oriented FOFs. Here, similar to equity mutual funds and stocks, the holding period will be that of 1 year. If you're selling it before 1 year, it will fall under short term with a 20% taxation. And if you're holding for a period of more than 1 year, it will fall under long term capital gains with the tax rate of 12.5% and also an exemption limit provided to you, which is of 1.25 lakhs. This is for equity-oriented mutual funds. And the third category in FOFs is the hybrid funds, the commodity funds and international FOFs. Similar to how it was for mutual funds, here the taxation will be based on short-term and long-term, where a 2-year benefit is provided to you. So if you're holding it for a period of less than 2 years, it will be under short-term and taxed at the slab rate. If you're holding it for a period of more than 2 years, then it will be at 12.5% with no indexation benefit provided to you. Just to clarify here, again, similar to how we have seen for mutual funds also, there's a specific definition for hybrid fund of funds, in which case, if the fund is not invested more than 65% in a debt fund or more than 90% in an equity-oriented ETF, in that case, those funds will fall under the hybrid category, and hybrid FOF-related taxation will apply to them. For all of these fund of funds, we have one example which we can show it to you.
Yeah. So again, we have to refer the similar report itself, which is MF Debt Hybrid Funds. Again, I'll simply open the same report here, which I've already generated. As you see, I've also added one fund of fund here, which you see, the second last fund, ICICI Prudential Dynamic Asset Allocation Active FOF Growth, which is a fund of fund. And you can see that there is a purchase was on Feb 23, and the sale was in December 25. That is this financial year. So as per the criteria, it is showing long-term capital gain. So for debt-oriented fund of funds, you can definitely refer this mutual fund debt hybrid report. And if it is equity-oriented fund of fund, you can refer the mutual fund equity report. So that you need to refer two different reports to get the details, as the criteria is different there.
Thanks, Tanmay. Moving on to the next category of investments, which is the ETFs, specifically the gold and silver ETFs and the international ETFs. For gold and silver ETFs, the holding period is that of 1 year. In budget 2024, they had clearly specified that for anything which is listed, the holding period will be 1 year. Anything which is non-listed becomes 2 years. Similarly, for gold and silver ETFs, since it is listed on the stock exchange, the 1 year holding period rule will apply. If it is short term, it will be at the slab rate. If it is long term, it will be 12.5% with no indexation benefit provided. This is for gold and silver ETFs. Similarly, even for international ETFs, which is the next slide, the same rule applies, holding period of 1 year. We'll show one example in this case.
Yeah. Again, so all the ETFs are also covered on the mutual fund debt side, I would say, debt report. So we have two different options available. You can manage ETFs under equity, that is stocks and ETF section. Or let's say if you are getting data through mutual fund feeds, okay, maybe you're importing certain file and ETFs are available in mutual fund data. There is also option available where you can add certain ETFs on the mutual fund side. Irrespective of where you add it, you can still generate, you can go to report section and still generate this particular report, mutual fund debt hybrid, where again, all the ETFs will be covered. Again, I'm opening the same report, which will show ETFs as well. So if you see the last asset, which is Axis Gold ETF, this was showing long-term capital gain because the criteria is 1 year. So May 24, it was purchased and then sold in March 26. So it is showing it as a long-term capital gain. Yeah, Radha, we can talk about the bonds. Yeah.
Thanks, Tanmay. Next, we go to traded bonds. Here, for traded bonds, the holding period is greater than 1 year with no change at all in the budget which was announced. If it is less than 1 year, it will fall under short term with a slab rate taxation. And if it is greater than 1 year, it will be at 12.5% taxation with no indexation benefit provided. So for traded bonds, it is simple, similar to stocks. 1 year is the holding period, less than 1 year is short term, and greater than 1 year is long term. We can just show one example for that, or
Yeah.
we'll cover.
Yeah, even if it's same for sovereign gold bonds as well, with a slight change. Rather, you can just quickly
Yeah.
cover that as well, and
So,
then
so for sovereign gold bonds, also it's similar to traded bonds, where 1 year taxation, 1 year holding period rule applies. If it is less than 1 year short term, with a tax rate of being added to your income and tax at slab rate. If it is greater than 1 year, it will fall under long term with 12.5% no indexation. And the change here is if it is held till redemption, if the sovereign gold bond you have purchased, if you have held it till redemption, which is a 8 year holding period, in that case, there will be no capital gain applicable to you because you're holding it till the end of the bond's life cycle. There has been certain changes in sovereign gold bonds which will be applicable from the next financial year, which is financial year 26-27, which was just announced in the budget of February. but those will be applicable from next year. So we'll cover it, during that specific time. But for this year, the only rule is that there's a 1 year a 1 year holding period limit, and the exception is if you are holding this fund till redemption of the SGB. In that case, there will be no capital gain applicable to you.
Yeah.
Yeah.
So just to show you it in app, we have a separate asset category called traded bond where you can manage all the listed bonds, tradable bonds, and which basically covers any listed bond as well as sovereign gold bonds. To generate the report, you can go to the report section. Again, refer capital gains ITR format section. And also for bonds, there is a traded bonds as a separate section available. So if I simply generate this report, it will give you all the capital gain details for various bonds you're holding.
Correct.
So as you see, it's 1 year LTCGs. If you're holding less than 1 year, it's short-term capital gain. If you're holding more than 1 year, it's a long-term capital gain, similar to the equity, I would say. And for sovereign gold bonds, again, if you are holding it till maturity and then redeeming it, there is no capital gain tax applicable.
Thanks, Tanmay. Moving on to the next asset class, which is the REITs and InvITs. For REITs and InvITs, again, the taxation is of the holding period is of 1 year. If it is holding period is less than 1 year, it will fall under short term. Here, the tax rate is 20%. If you are holding it for a period of greater than 1 year, then the tax rate is 12.5% with the exemption of 1.25 lakhs provided to you. So again, REITs and InvITs, clear distinction for short term and long term. Holding period of less than 1 year falls under short term, greater than 1 year falls under long term. Every quarter, REITs and InvITs give certain distributions to their investors in the nature of interest, dividend, repayment of debt, or repayment of capital. There are different taxation rules which apply to all of these distributions. For example, interest and dividends are added to your income and taxed at slab rate as per your income. And whatever rules apply to interest and dividends, they will be added to your total interest and total dividend. The specific distribution, which is the repayment of debt, repayment of capital, or repayment of principal, are three different names which each REIT and InvIT use interchangeably. This actually impacts your cost of acquisition. So it actually lowers your cost of acquisition, and then the capital gain is calculated depending on that. So let's say your cost was 100 rupees and the repayment of debt was 10 rupees. Your new cost becomes 90 rupees. And let's say your selling rate was 120. So your capital gain is calculated as 120 minus 90 instead of 120 minus 100. Right? So this is the difference in terms of the different distributions that the REITs and InvITs give you. Just to summarize this asset class, there are different taxation rules for the distributions that they are giving you. If the distribution is in the nature of interest and dividend, it gets added to your total income. If they are giving you distribution in terms of repayment of debt or repayment of capital, that actually reduces your cost of acquisition, and basis that cost, the capital gain is calculated. And for capital gain, the holding period rule is of 1 year. So if it is less than 1 year, the tax rate it is applicable is 20%. If it is greater than 1 year, the tax rate is 12.5% with an exemption limit of 1.25 lakhs.
Yeah, and would like to add one quick thing here that earlier all the quarterly distributions were not part of the auto corporate actions. So recently we have made a provision where along with other corporate actions like bonus split, merger, demerger dividends, which were there for stocks, can be automatically applied. Now, along with that, you can also apply quarterly distributions automatically for REITs and InvITs. So that's a new improvement we have done in the applications. Now, these things will be automatically handled through the corporate actions. So let me quickly show the capital gain reports as well. So for management purposes, it can be added under stocks and ETFs, but when you generate the report, capital gain report, there is a separate section, separate report available for that. So I can simply click on InvITs and rate and simply generate this report. So based on 1 year criteria, it will show me short-term and long-term capital gain details. Like so, as you see, Mindspace Business Parks REIT, it was purchased in October 24, sold within a year, July 25. So it's considering it as a short-term capital gain. whereas IRB InvIT fund, it was purchased in October 24, sold after 1 year, holding for more than 1 year, and then sold on December 25. So it's considering it as a long-term capital gain. So all this, again, ready-made reports generated. You can easily download it in Excel and PDF, both the formats.
Thanks, Tanmay. And one last thing that we'd like to cover for today's webinar before we move into Q&A is the tax loss harvesting. Tax loss harvesting has been widely used by investors, wherein they sell a loss-making security to offset any capital gain which they have received on other assets. Um, there are certain specific rules when it comes to tax loss harvesting and carry forward and set off of capital losses. But just to summarize, let's say your capital gains is 50 lakhs and in few securities, and in some security you're actually facing a loss of 10 lakhs. You can actually sell that, realize the 10 lakh loss, and then your net capital gain will be 40 lakhs and the taxation will be on the 40 lakhs instead of the original 50 lakhs. Now, how does this actually work in terms of short-term and long-term? Is that short-term capital losses can be set off against both short-term and long-term capital gains, but long-term capital losses can only be set off against long-term capital gains. And there are certain rules in terms of, whether you can claim this short-term loss, whether you can carry forward it, so on and so forth. As per income tax guidelines, that is, you have to file the return up to a specific date, etc. We have actually done a detailed one-pager note explaining entire tax loss harvesting. We'll also post the link of that post on our chat here. I'll request the person in my team to just put that note so that all of y'all can access it, wherein we have given a detailed explanation on what is tax loss harvesting, what are the rules applicable, and how does the entire process work. Right. Tax loss harvesting, usually people do it in this month before the financial year ends. So any capital gains which they want to be offsetted against a capital loss can be done this specific month itself. So before the 31st of March 2026.
Yeah, and we basically provide a ready-made report for just like realized capital gain, which I was showing you, book profit and loss. We also provide unrealized capital gains, which you can definitely use for tax loss harvesting purposes. So there are two reports available. One is a summary report and second is a detailed report. I'll recommend you to go with a detailed report. Just for the demonstration, I'll open the actual report here. Let's say mutual fund debt hybrid report. This will basically give you complete understanding that if you exit particular mutual fund as on current NAV, what will be the gain or loss you will be making. So this will give you complete clarity, whatever assets you're holding, whether it's a stock, mutual fund, bonds, REITs, InvITs, you'll come to know that if you exit, if you sell particular asset today, what will be the gain or loss, whether that will be a short-term gain or a long-term gain loss. So by looking at this report, now in this example, of course, there is no loss here. Almost all the assets are in profit if we exited today. But let's say if there is a loss, others already informed about the criteria that short-term capital gain can be set off against short-term and long-term, but long-term capital gain, long-term capital loss can be set off against only long-term capital gain to reduce the overall tax liability. But this particular report will definitely help you to make that decision. It's a ready-made data which we are providing for different asset classes. So you can just generate this report, see which different assets are making a loss, and then you can take a call to set off against gain and reduce the overall tax liability. But this is the right time to look at this report and take a decision overall.
If you have any specific question regarding reports in MProfit or any specific feature you want to understand in more detail, please do write to us at support@mprofit.in and we'll have a specialized person guide you on those things as well. Thank you so much for joining this session. Tanmay, if you want to add anything.
No, that's it. I mean, so once again, thank you very much for joining the session and staying till the end. We have tried to cover most of the questions, I would say. Of course, certain questions, it's not possible to cover all the questions, but please feel free to write us at support@mprofit.in if you need any specific help related to the application, if you need the software demo, if you have any, or if you're already user of MProfit and if you need further assistance, please write it to support@mprofit.in and our relevant team will get in touch with you. So thanks a lot. Thank you, Radha. So we are
Thank
concluding this session here.
Yes. Thank
Thank
you,
you.
everybody.